Really nice intro. So good morning, everyone. Good morning to those on TV as well. I'm excited to be here because I've been coming to this conference for years, and it's always sort of, true thought leadership. Today, the title of my talk is Conglomerate Boom 2.0, a stable platform, question mark. The goal of this topic is to really lay out what I view to be the current framework of the market. And I think when you see sort of, as we progress, I think you'll see that to the extent that you agree with my perspective, there's going to be a lot of outstanding short ideas that come out of it. At a minimum, though, if you don't agree, I think at least having this awareness, could help you avoid losses down the road should, some of these things come to fruition. And I think to just prove my point of sort of the power of understanding market regime and historical analogy, I thought it would be fun. I knew Jim Chanos was going to speak on energy. Energy was a big short theme for us last year. We were pretty defensively positioned, but we were very short energy. And so it was a good year in that respect. This is the clicker. Got it. Oh. Sorry about that. Okay. So this is a chart. This is sort of my way. This is my language of translating what Jim was saying into sort of my core belief of cycles. And this is a chart that we put in our second quarter letter to investors last summer. So this is, oil was at $100. And we were, getting ready to be very aggressively short energy, the commodity, the underlying names. But we're sort of waiting for the market to give us a tell for sort of the turn. And what this chart just shows, though, is this is the global E&P spending on an 8-year lag to U.S. private fixed residential investment. And obviously, I don't need to tell you what happened with housing. But you can see at the time last summer, the street was sort of extrapolating that global E&P spending would kind of continue to grow up into the right. And the point of this chart is, the creeping compounding effects of cycles, right? So, housing is an example where for a couple decades, even through a couple recessions, a little setbacks here and there, but it grew at sort of a mid-single digit rate. And then sort of into the final stages of the boom-bust cycle, it accelerates and it grew at double-digit percentages, and then ultimately it collapses on itself. And you sort of saw the same thing in energy. Very few people trading today remember the Saudi Arabia analogy and weren't really taking note of all of the liquidity coming into the high-yield markets early last year, specifically in energy. In fact, energy as a percentage of high yield, you hadn't had a sector that had that much exposure since telecom. So, with all of that, the street was extrapolating, and then this is obviously what happened. And so the point of this is that even if you're sort of not sure that the turn is there, it gives you at least the confidence to maybe press some shorts, but also the confidence to not want to buy the dip, to not just sort of step in and say, oh, this is a buying opportunity, this stock is down 50%, when you sort of recognize that actually there's a much longer cycle at play, and so it gives you pause. So with that, I figured I would just, I'm going to get into the topic, and I have to give you a lot more background, which I think will be kind of fun, but it's going to be, it's going to be a little academic, but I'm going to give you some background on Conglomerate Boom 1.0. Then I'm going to give you background on a tax arbitrage boom, and then we'll go into the platform boom, Boom 2.0, that I see today. So the 1960s conglomerate boom, the 60s was actually a somewhat similar period to today. You had low and stable inflation, apparently, low interest rates, muted economic growth. And at the time, the mutual fund industry was sort of on the rise, and there were these go-go funds, sort of the aggressive mutual funds of the day that really wanted growth. And the problem is that there just wasn't a lot of growth outside of a handful of companies that were providing that, and so they were, developed an infinity for these conglomerate stocks. And the conglomerate stocks, the way they were getting the growth is they had very high multiples, and they were using their equity, with pooling accounting, they could basically stock swap and acquire companies very accretively. So they would go out, trade it at 50 times earnings, they would acquire something for 15 times earnings, and lo and behold, that's fantastic growth. At the time, there were also a lot of perceived synergies because these were fantastic capital allocators, And so these CEOs would be able to take the money from one company and reinvest it. And so at the time, there was this perception that there'd be a lot of synergy and great capital allocation. These are, this chart shows you some of the conglomerates of the day. You probably recognize some names. You have Harold Janine of ITT, Saul Steinberg, we're going to talk about him in a minute. And then, of course, there's Henry Singleton, who a lot of you will recognize that name, but for those of you who don't, he's considered sort of, if not one of the greatest capital allocating CEOs of all time. And so he really sort of rose during the conglomerate boom initially. And we're going to talk about him in a minute. So this is a chart that we put together that shows you this index of conglomerates kind of in the 60s through to their peak in 1968. And you'll see that the conglomerates actually outperformed the S&P by over 500%. What's really interesting here is, so in 1967, the economy really started to slow down. Growth was muted, but from 66 to 69, conglomerates were responsible for 80% of the M&A in the market. So you started to see the economy stall out, interest rates were going up, and yet the acquisitions just literally started going almost parabolic. Then, of course, what happened? Well, eventually, you get too big for the next acquisition to be material. You hit the top of the market, and the economy turns over. And in this case, the economy turned over, rising interest rates, a stalling economy. There's a negative feedback loop. And of course, what goes up obviously goes down just as swiftly. And you can see here, this is the following 2 years after the collapse of the conglomerate boom, where all of those companies were down about 79% over the following couple of years. What's also important to note here is that this was a real tell for the bear market. When these stocks started collapsing, the rest of the market soon thereafter collapsed as well. And so we went into the sort of the 1970s bear market. And these were, the speculative leaders of the day. They collapsed, the economy tanked, and so on. So I wanted to do a quick case study before we move on to the next example, and you'll see why it's relevant in a minute. But the history books really ascribe the end of the conglomerate boom to the collapse of Litinsky. So Litinsky was headed by Saul Steinberg. This was a company that basically came out of the pink sheets a few years earlier. So started from nothing, this very scrappy guy, and he goes out, he takes his company public, and very quickly just buys everything he can. And by early 1969, he was bidding for Chemical Bank, which was the 6th largest bank in the country. Well, the financial establishment did not like that very much. It's one thing if you got a guy on the sideline who's buying everything he can. It's another thing when all of a sudden you're on the front page of the newspaper and you're some outsider who's sort of coming in to kind of mess with the establishment. And so what the Chemical Bank executives did is, because most of this stock was held, most of Litinsky's stock was held by a handful of go-go mutual funds, the Chemical Bank guys went down the road and effectively, and maybe I can't prove this, but it's what the history books say, went down the road and got them to dump the stock. And so quickly, Litinsky's stock broke. They then went to the banks that were funding Litinsky and said, you better cut them off or else. And very quickly, Litinsky was just killed politically by creditors, by equity holders, and you can see the fall within a year, within a little over a year, was down almost 90%. So that's the boom 1.0. Let me just do one other boom, which is and this will all come together, I promise, the paired share REIT boom. So some of you, this is a little bit more recent, but the paired share REIT boom was really a tax arbitrage boom in the mid-1990s. It was really sort of the leader, the poster child of that boom is Barry Sternlicht, who effectively acquired a small paired share REIT and built it. And just for background, there were 4 paired share REITs. And what the paired share REITs allowed you to do was you had a passive real estate company and an operating real estate company, and they were paired together. So you could actually more tax efficiently own and operate real estate. So these guys had a cheaper cost of capital. And so they had been grandfathered and been around for a number of years, but no one really ever did anything with them. And there were only 4 of them. And so Sternlicht got one and started acquiring hotels. And then the other 3 went into play. Apollo went after one. Colony, Richard Rainwater tried to get in the mix. There were a lot of people who were sort of getting in the mix. And this stuff took off. And you can see here that in a bull market, the paired share REITs, very quickly skyrocketed over a couple years. This cost of capital arbitrage that they had was, really enabled them to kind of acquire and benefit, and so the market loved it. Then, as it became front page news, people weren't happy about the loophole, and President Clinton came out and said that he would do something. His members of Congress spoke, and then a year later, Congress changed the law. The important thing, though, is that actually it was sort of front page news, and it collapsed long before the law changed. And so you can see that. And then on this next slide, I just thought I would, so this is the rise and fall of Starwood. And you can see here, Sternlicht was able to grow from basically nothing to acquiring Weston and then ultimately acquiring ITT, a remnant of the 60s conglomerate boom. Many of the 60s conglomerate boom companies had by the 80s been all split up and broken up, but ITT still remained and it owned Sheridan. It was much larger than Starwood, but given his high-priced stock and cost of capital advantage, Sternlicht was able to acquire it. But literally, the day of that deal was the top tick. That was sort of the peak acquisition. I think the market recognized that he couldn't really grow beyond that, and so the stock then collapsed. And what's interesting is that the stock collapsed in a bull market, right? I mean, this is the late 90s, and you can see the power of this tax arbitrage for this boom-bust cycle. So with that, I want to get into what I believe to be the platform boom, which is what we're living today. And I believe we're actually sort of witnessing the beginning of that collapse. And maybe it's not viewed in this context today, but I think in time, if I'm right, it will be. Let's look at it compared to the first boom. Obviously we have a low and stable perceived inflationary environment, according to probably not the people in this room, but according to the Fed. And we have financial repression, right? So there's we have muted economic growth. I think post-08, we all sort of agree with that. And instead of the go-go funds, we have event-driven hedge funds, value plus catalyst, or people who really want to see growth. You want to wake up that morning and have your smart capital allocator CEO having done something that is going to make your position go up. And the slight nuance is that instead of this pooling stock for stock accounting, we have financial repression, which is enabling extremely cheap debt capital to be issued against assets that may have a limited shelf life or otherwise may be sort of declining assets. But because of the credit markets where they are and the financial repression that we're in, they're still able to kind of do this. And so that's the nuance. It's sort of a debt-driven boom as opposed to a stock-driven boom. And then we have the, similar to the paired share reboom, this concept of corporate tax inversions. I'm sure everyone has read about that, but you have sort of a whole segment of this market that's also participating in this, but is also involved in a very big tax arbitrage. And so those are the conditions for the platform boom. Now, here are the companies. This is an index I created. There's 24 companies on here. By the way, it's maybe hard to read, but for those who want it, you can contact my firm through our website. We're happy to send out this deck, or Jim as well. But the names on this list, you'll see, Allergan, Anheuser-Busch, Valiant, of course, is the poster child. We're going to talk about them plenty. I don't think I could leave this conference without doing that. Endo, and so on and so forth. And you'll see some of these other names in this sort of a big list of sort of these companies that I consider. Now, there's probably a few that I've left out, and then there's probably a few that don't belong in here. But this is sort of my best guess of sort of what my team and I have created and have decided to participate in on. So here you can see actually this is the boom. This is up until the peak in July of this year. The platform companies, since the March of 09 lows, have gone up over 1,000%. This is an 800% gain relative to the S&P. To put this in context, this is substantially larger than the 60s conglomerate boom. And frankly, as I told you, I believe it's magnified by this tax arbitrage that's sort of heightening and fueling the boom. And so the platform boom is the Bible. The Bible for the platform boom is this book called The Outsiders. And Thorndike is the author, and I'm going to read you a quote in a second. But it's about these 8 unconventional CEOs who were sort of considered to be the best compounders over time, the best CEOs. And sort of the takeaway from the book is he did a big study and said, this is how a CEO should act. And let me just read you the quote because it's powerful. They disdained dividends, made disciplined, occasionally large acquisitions, used leverage selectively, bought back a lot of stock, minimized taxes, ran decentralized organizations, and focused on cash flow over reported net income. Now, many of you, if you can't see the names, Henry Singleton, of course, is on here. Warren Buffett, of course, John Malone, Kay Graham of Washington Post. The funniest one, I think, is Bill Sturritz, who is actually the CEO of Post, who's a current platform boom candidate in my index. He coincidentally, as a total aside, owns more of Herbalife stock than he does of his own conglomerate. But anyway, the point here is that these are some of the 8 best CEO capital allocators of all time. And this is sort of the textbook thing that you want. And it's outstanding. And I'm not in any way knocking it. I think, I look for this every day when I invest. But I think what you're going to see on the following slides is that actually in our thirst for yield, in sort of our thirst to, as investors, to sort of believe in others, that we've got a perverted sense of this, and that financial repression has enabled effectively over the prior years a perverted sense of this to sort of take place in the markets, and due to that sort of creeping compound effect, I think people aren't sort of fully aware of it. And so before I go to the next slide and kind of walk you through, this cash flow over net income is a perfect example of where to start. Look, I'm a free cash flow guy. I run a hedge fund. I want to be a thoughtful investor. I focus on free cash flow. I mean, that's ultimately what we talk about when we're at investment committee and we're going through things. But accounting principles, they're kind of like, I don't know, prostitution or multi-level marketing. You may think they're completely wrong, but they've kind of been around forever for a reason. And so when we think about our platform boom companies, the 24 companies on my list, they have an aggregate of $800 billion of equity market value. $800 billion. Their aggregate tangible book value is negative $272 billion. And by the way, not a single company, not a single company on that list has positive tangible book value. So this is just sort of, this is kind of the creative accounting, the healthcare companies. I think a lot of this has been written, but let me just give the quick background for those who aren't fully aware. A lot of these healthcare conglomerates, they either acquire, you can listen to what they say, or you can just step back and think about it for a second, right? You either own a branded drug or a generic. Historically, generics had mid to high single-digit price declines per year. In the most recent few years, there's been, a lot of labs have been, or facilities have been shut down, especially in India. There's been some shortages, some FDA approval issues. Generics have been in short supply in some areas, and so you've had a cyclical phenomenon where prices are actually going up. And, obviously, we'll get into pricing later as to kind of what's happening, but for the most part, they go down. And then a branded drug has a life of 20 years or less. Sometimes there's extensions. But the point is GAAP earnings are lower for a reason. The amortization is real. These are declining finite-lived assets. So when you look at one of these pharma conglomerates, you should recognize that their GAAP earnings are really what's real. Let's move on to pricing. I think you'll see these top two on the left there are the two Valiant drugs, Nitropress and Isoprel, which are sort of getting a lot of press right now. It's interesting. No one's focusing on this, and I don't know why, but sort of one of the bull-bear debates that is going on in this name is that people argue that Valiant bought those two drugs the bears would say they bought those two drugs to make their quarter, they jacked price. But what's so fascinating is the company that owned those drugs before had jacked prices up 300%, and there was actually a letter from Sanders and Cummings and a number of members of Congress to that company saying, why have you jacked up prices, starting to investigate them. And so Valiant obviously would have seen that letter in their due diligence process, proceeded to acquire that company and raise prices another 300 and 700% in one case. So, and literally that, overnight to kind of, some would say to hit their quarter, others would say to take care of discrepancies in sort of price versus value. But it's not just in drugs where you're seeing this pricing effect. This concept of, when it was the platform day, you had these, Kay Graham ran a media monopoly. Now, it's sort of over the top, has killed all of that, but Kay Graham of Washington Post ran a media monopoly. and so did Tom Murphy of Cap Cities. They could comfortably raise prices because they were the only game in town. If you're selling what is sort of an unhealthy consumer brand or beer or something where you're actually experiencing quarter over quarter over quarter over quarter declines, and yet you're jacking price, and you're dramatically raising price, that works. That makes sense for a short period of time. But the question is that truly a sustainable business model? Should we assign the same benefit to a quote-unquote new outsider CEO for raising price in the midst of volume declines the same way we would assign that sort of geniusness to Tom Murphy of Cap Cities? I don't know. That's a questionable thing. And you can see here, you're seeing that across some of these names. Next, and we talked about tax arbitrage. By the way, I thought it was interesting. The cover of the New York Times business section today had an article about questionable tax tactics from AB InBev. So I wanted to give you that example because you can see here, these are the pharma conglomerates. You can see the dramatic differences in their tax rate that they achieved due to inversions. And so, this has been an arbitrage that a lot of them have been benefiting from. So a lot of the growth that you've seen and their accretive acquisitions have been a function of sort of this tax arbitrage that you see here, this differential between sort of their previous and next tax rate. So moving on, what do we witness? What do we see? Very similar to how Boom 1.0 ended. You see an accelerating volume of acquisitions. Maybe we're mid-cycle. It's very hard to call economic cycles, but we're certainly 6.5 years into a cycle. And so we're somewhat late cycle, I would argue. And yet you're seeing now an accelerating volume of acquisitions from these companies, very similar to that 66 to 69 period of the conglomerates. And by the way, by the time that was hit, those stocks were dead money. Even if it lasted another year or two, you could see in the chart those stocks were dead money. And you're seeing this acceleration of debt issuance to get these deals done. And then the question, though, is when you think about this acceleration of debt issuance, and you think about the fact that they're actually buying what are declining cash flow streams, assets that will not maintain their value over time, are these deals actually going to prove to be accretive over a long period of time, especially when a lot of that debt's going to have to roll at higher interest rates? So next, I thought it was interesting, just as you saw in the prior examples, typically once in a boom bust cycle, once you become front page news, that's not good. Here I thought it would be interesting to just throw some quotes in here. The first one is from Jack Lew, who obviously talking about tax inversions. Of course, there's Hillary Clinton's tweet heard around the world. And then, the Justice Department is investigating AB InBev for their anti-competitive behavior with craft beer distribution. Valiant, of course, has been subpoenaed, and it's not just federal, by the way, so it's state as well. You have a number of states investigating generic drugs. A lot of people are concerned about price gouging. And so these are just some quotes. Again, California investigating AB InBev. And so the point is that these conglomerates, the new platform boom, they've all become front page news, right? So it's topical. It's in everybody's mind. They're too big now to sort of quietly take advantage of an arbitrage. They're too big to grow. So I believe it's inevitable that regardless of what your view is on lower for longer, we will one day have a rising interest rate environment. And by the way, I would argue, so I've heard some arguments out there that, you don't have to worry about a bear market until the Fed hikes. And so because we're at the zero lower bound, actually, the show goes on. Well, QE ended in October. That's a form of tightening. We've sort of never been in an environment like that, but a year ago was the first hike. That was the end of QE. And then I think you could also argue that the end of the EM unwind, the EM unwind that's happening in recent months is another form of tightening. So we're actually experiencing this tightening that is sort of typical of the end of these types of booms. And so then the question is as we experience this tightening, as the economy is slowing, what's going to happen? And here's what we're seeing. If you look at our platform index, since July when this topped out, and I think soon thereafter you had Hillary's tweet heard around the world and the healthcare names blew up, but you're starting to see some of these other names teeter. you're seeing this turnover. And I thought, before I get into some final stuff, I'd talk about the lease co of our day, which is Valiant. And I guess I'm preaching to the choir here, so maybe I'll go through it really quickly. But Valiant is sort of the poster child of the platform boom. As you can see, they did their tax inversion. They've been an aggressive acquirer. They did the pricing, all of that. And so you can see the boom-bust cycle. They acquired a bunch of stuff and continued to acquire, It was all very accretive, tax arbitrage. Everybody loved it. Michael Pearson's amazing, and then, collapsed. And so here I just wanted to show this slide because there's a lot of people who've done, but I just wanted to step back and sort of, in very simple terms, describe what this company is, because I think it's actually sort of not necessary to really focus on the details. It's just sometimes it's important to really just step back and think about what this company is. It's effectively a stub of assets and then a bunch of stuff that they acquired from 2008 to today. And to do that, they spent $43 billion. So that's what it cost to kind of assemble what it is that this company is. Regardless of, I would argue that the strongly significant majority of their assets are declining to zero over a long period of time. They'll tell you that it's a smaller percentage. Whatever the case, the fact is that they spent $43 billion to buy it. The enterprise value, well, this is as of Thursday, and I think it's gone down a bit since then, but the enterprise value is $91 billion. And so the platform value, what I would say is the quote-unquote platform value of this company is the amount that exceeds costs. Now, this $48 billion platform value, you have to adjust that because they have a tax arbitrage, they have a great CEO who's zero-based budgeting and cutting costs. And so there's some value to that. And so the question, but by the way, that's mitigated by the fact that the assets are declining over time. So the question is, let's just say that all offsets each other. Would you pay $48 billion for one person? I mean, you can, and I'm not recommending it, but you could go buy Blackstone for $40 billion. And so he has to, Michael Pearson has said on his call yesterday, he has to go, and now they're changing their business model. They're going to spend more on R&D. They're not going to buy this. They're going to spin off that. And so ultimately, you may have an outstanding investor, but the point is he's got to invest the capital. And you're now paying $48 billion for this. It kind of reminds me of a couple years ago. Some of you may know this, but it reminds me a lot of the Ocwen complex, which was run by this gentleman named Bill Irby, and he lived in St. Croix, and he had a tax arbitrage, same thing. And he had this hodgepodge of companies that he took public, and it was all sort of related around the housing, kind of fixing up houses and, buying bad loans. And anyway, he had a tax arbitrage, and at one point 2 years ago, the aggregate of his five, he had split it up in different parts to get the cash flows. The aggregate 5 companies that he had were worth more than KKR. And I thought that was so fascinating. And then, of course, the tax arb ends, he was investigated, the thing collapsed, and you can read the history there. But I just thought, when you think about Valiant, forget the equity story for a second, and forget the fact that you have really what are a handful of funds in this thing that are, very illiquid, and pretty much a handful of people revolved around the same thesis. But when you think about this, why would you want to be a creditor to this? You have a bunch of stuff that cost about $43 billion. The net debt is almost that amount. You know that eventually this debt is going to have to roll at likely higher prices. And so that, I understand, fine, you want to play the equity story and you think that there's another deal around the corner, but to be a creditor just doesn't really make much sense. And the credit markets are figuring that out, and you're seeing the spreads widen. And the spreads in the last couple, month or so have widened 160 basis points. And of course, as those spreads widen, that reduces the arbitrage, the cost of capital arbitrage, and that reduces the platform value. And like the prior feedback loops that we saw, you will see this, this feedback loop kind of continue to reverse upon itself. And so I just thought I would put these charts up against each other: Lease Co. of Boom 1.0 versus Valiant of Boom 2.0, and you can see. It's a very similar story, just a different costume. Lease Co. reached too far and was killed by the political establishment. I think it's arguable, fair to say that Valiant reached too far. They were hyper-aggressive with pricing. I'll choose my words carefully. And they're now in the process of being killed by the political establishment. You've now seen, by the way, not just the Democrats, you've seen the Republicans come out. Senator Rubio made an outstanding, strong statement the other day. So you're seeing Congress kind of come after them. And so then the question is, and then ultimately the equity and credit markets will could kill this company as well. And so I just wanted to put this, the current boom up against the prior one. And you can see, actually, when you look at these companies, actually, because of the tax arbitrage and because of financial repression, boom 2.0 is actually substantially larger than boom 1.0. And so there might be quite a ways to fall. Not to mention, if we just, before I do that, not to mention that real growth in the 60s was around 5% for most of the period. It's been around 2% now. So you've actually had this more extreme boom in a much lower growth environment. So by the way, I thought just to finish out the cycles part, and here's where you can sort of, I think, start to think about this stuff and make money. I wanted to put up a few quotes of, the first one is a quote from Michael Pearson, who a couple years ago said they would be a $150 billion market cap company. Jorge Lehman of 3G said, we'd love to take a look at Coca-Cola. We could run it with 200 people. My favorite is Patrick Drahi's, we'll buy a second, a third, and one day we'll be able to say, hello, Mr. Comcast, hello, Mr. Charter. These quotes, actually, they remind me, I was trying to remember when I was doing this slide, they remind me of being at the Milken Conference in 2011, when Ike Batista got on stage and said, I'm going to be the richest man in the world. 2 years later, his companies were on the brink of bankruptcy. So I came up with the quote, this sort of my summary. When an outsider meets a cycle, it's likely the cycle whose reputation will remain intact. So just putting, boom 1.0, and here's where it gets actionable, right? So you think about boom 1.0, look at Teledyne. So if you see this second column, you can see Teledyne was actually, when the feedback loop goes in reverse, all babies go out with the bathwater. It doesn't matter if you're a good guy or a bad guy. So, Lisco went down, so did Henry Singleton, and, he took decades to kind of build what he built, but he got hit just as hard. And so I think the way you need to think about the platform boom is that everybody's going to get hit, all of these aggressive acquirers. The feedback loop has started to go in reverse. And so, and then I thought, so you can see, obviously, and there's a number of them. It's not just the 3G companies of Kraft and Bud, but you can look at the rest of my list. But those are great candidates, and I think those are great candidates because look at next. So this is our case study on Bud. What just happened? Last week, they announced the largest consumer acquisition in history, a $106 billion acquisition. They're going to finance it with $70 billion of debt, and they have to get this deal done, they have to sell in an extremely dilutive way assets in China, assets in the US. They have to do whatever they have to do in South Africa to get that done. And so they're going to be around the world handing out value to governments while they take on a massive amount of leverage and try to integrate the largest consumer acquisition in history. They may be an outstanding management team, but at some point, it goes too far. And by the way, fine, let's say they get this done all fabulously well. What do you do from there? And you start to look at what's priced and you think about it. And so I thought I just wanted to have a couple more slides and show you. This is a slide that I love. And if you guys remember, in early 2009, the market was a third of the price. The S&P was at 666, and credit spreads were at record highs, and everyone was worried about this looming wall of maturities. And what happened? Well, the Fed gave us a lot of juice and kept rates low, and everyone was able to pretty much roll financing, and kind of things worked out okay. The default cycle wasn't that bad. The lesson learned was buy everything you can, right? In this cycle, what's interesting now is here we are 6.5 years later. We're ultra late, mid, or very late cycle. You're seeing these gigantic transactions, $100+ billion Bud deal, $70 billion of debt, Dell EMC. It goes on. You can just look at the amount of peak type deals you're seeing. And you see, by the way, our looming wall of debt maturities is actually substantially larger than in 2009. Now, nobody's worried about it because it's backdated. Oh, you don't see it for a few years. Well, the difference this time versus then is, one, by the way, this is all being done, we're 6.5 years into a cycle. And so we're very late cycle versus at least back then, you had an economy boom to help you out a bit. But we're very late cycle, and it's likely, now who knows, but it's likely that most of these debts are going to be rolling at much higher prices. And so at some point, maybe it's tomorrow, maybe it's 2 years from now, but people will start to stop and say, well, if the capital structure of the company is sort of X of debt and Y of equity, and this debt costs this price, and it now is going to cost this price, and they're going to roll it at this price, well, that's dilutive to the free cash flow of the business. So how am I going to adjust the equity value? And then that may feed on itself, especially for some of these aggressive acquirers. There's just this last slide, and just to kind of back that up, I haven't seen this anywhere, so I thought I would just throw it out about this bull market. I would actually argue that this has been the largest bull market in history. And the way I get there is actually, if you just look at and by the way, bigger than 87, bigger than any prior bull market, just the fourth longest in duration. And the way I get there is just take the compound rate of the S&P less nominal GDP growth. And so the concept is just sort of the expansion of the market relative to what should be a proxy for earnings and real growth. And you see that actually this has been a huge bull market. We know why, because of financial repression. But it is important to think about this in the context of highly speculative companies that are sort of doing constant deals. So I guess I would just conclude with that note of saying, I like to adapt Benjamin Franklin's quote of death and taxes and say death, taxes, and cycles. And I think that Platform Boom 2.0, when the history books are written, will be a story of this, investors who are starved for yield in a financial repression are sort of reaching out to find belief in capital allocators who are these sort of all-knowing people who've generated a lot of value over the cycle. But it's a reach too far. They sort of believe that past performance is a certainty of some kind of guaranteed future performance and have priced it as such. And I guess I would just conclude by saying maybe Boom 2.0 has taught us a thing or two about the certainty of taxes. But if you want my opinion as far as the other two, I'll take the other side of that bet. Thank you. Any questions? Sure. Oh, questions? Oh, I think I see hands, but I don't.
Yes.
How do you?
When you were looking at Henry Singleton, did you wind up looking at what the conditions were before he really could undertake a lot of accretive activities for Teledyne? In other words, how far down the stock had to go and what kind of valuations it was trading at and what sort of market?
Oh, sure. Well, it's a great question. I mean, the key point on Henry Singleton or on any of these, any of the outsiders, is that these are track records built over decades in all sorts of markets. And yes, they took advantage of the markets. But these are, so Henry Singleton, when his stock price was very high, he issued stock and utilized that to kind of grow. And when his stock price was low, but let's not forget, he was on the cover of Business Week as a goat, right? And the point is cycles still do exist. And so it's not to say that you can't bet on great people. No, you should bet on great people. It's to say that at some point the concept of betting on great people becomes so asymmetric the other way that actually people have sort of gone into a groupthink the other way. And so I think you look at the Henry Singleton case study. And there's nothing sort of negative to be taken from that. I think he's one of the most outstanding investors of all time. But that track record took a very long period of time to do. And and when I say Platform 2.0, this is really over a few year period where you're talking about people who've taken effectively a tax arbitrage, some very aggressive to the extent of potentially anti-competitive and possibly immoral behavior, and have built gigantic businesses that are now on the cover of newspapers. Sure.
Can I just ask
a
question about shorting? So
Sure.
When you look at how you actually implement the short, do you wait to see a very large market cap deal and say this has got to be the end? Do you scale in over time and say it's got to end in a year and a half and I'll do a half year increments? Do you buy put options and just pay for the crazy volatility?
Yeah,
How do you
timing,
execute?
great question. Timing is everything. And very often you can let the market tell you, especially if you sort of have this cycle. I think in energy, for example, you could see the price of oil start to move, and then you could let the market told you that, and then you could kind of go into it. I agree, yeah. Usually it's as simple as when you see a transaction that large, if you believe that's the top tick transaction, you know, the opportunity to short on that's your tell. But there's no question that shorting is a science and an art, and timing and, you know, thoughtful process about cycles are two very different things. And you can really get burned, by the way, if you call it wrong, because sometimes a cycle is tested and it's not the turn, and it, you know, actually sort of fuels it even further. So you have to kind of be careful of that. Thank you.
Terrific.